Morning, everyone. Welcome to Ainsley News. End of the week. It's a must listen today. Paying for easy money. The US fiscal Ponzi scheme. Those who've been listening to our news for a while now know exactly what we're going to talk about today. But if you haven't, please join us. So, what's the best thing you could do to ease multi-decade high inflationary pressures and record high? It's 29 trillion and 159 trillion unfunded debt burdens if you were the US government. Approve a $1 trillion deficit funded infrastructure plan, of course. Classic. This week saw exactly that happen, and on Monday, Joe Biden will sign the largest federal investment in infrastructure bill in over a decade. Moreover, in securing the deal, he got Democrat support too for another $1.75 trillion for the Build Back Better bill, Jill. That's social safety net and climate package, and a commitment to railroad it past the Republicans in the Senate. $2.75 billion paid for, not through tax receipts, but by issuing more debt with the disarming name of US Treasury bonds. Let that sink in. With the Fed supposedly stepping away from the QE bond buying plate, one must wonder who in their right mind would buy all that debt. If buying is slower and yields rise, how does the government service the interest cost on all that debt? It already spends over $370 billion on interest payments, or over 9% of all tax receipts. Its debt to GDP is 130%. The US is looking at the double whammy of running a fiscal deficit, $2.8 trillion already, and a trade deficit of $1 trillion. And so, while monetary stimulus via QE is easing, fiscal stimulus is taking the baton and sprinting towards the cliff in its place. Is it any wonder that gold is on the move upwards? The abuse of the US dollar is currently of an unprecedented order. There simply must be a run to underpriced liquid hard assets such as precious metals. As usual, few can explain things better than Crescat Octavius Costa, and we include a full tweet thread from a couple days ago. It's a must read to bring all of the above and previous into focus. The government has been flooding the market with issuances of longer maturity instruments at unprecedented levels. The amount of outstanding marketable bonds and notes has increased by $626 billion in the last 3 months alone. There is a significant shift underway in the composition of debt maturities issued by the US government that could profoundly increase the supply of long-duration treasuries. The timing is particularly important as we're experiencing a macro regime change that is an abrupt reversal of a 4-decade trend of disinflation in the most financially repressive movement in history. More importantly, it also coincides with the Fed, the largest buyer of treasuries, planning on drastically reducing its net new purchases and cease them altogether 8 months from now. While we did not see this level of debt issuance last year, this has been happening all year. On average, the government has net issued close to $220 billion per month of bonds and notes. To understand the reason behind this surge in issuances, it's important to go back and analyse how policymakers initially funded the massive fiscal operations when the pandemic started. From March to June 2020, the government debt increased by $2.7 trillion, and 90% of this amount was issued through T-bills, which are less than 1 year maturity instruments. Such a large short-term issuance is not unusual in times of financial market stress. During a liquidity crunch, the demand for short-duration, safer assets increases, making it significantly easier for the market to absorb these newly issued treasuries to fund immediate fiscal stimulus measures. We saw a similar development during the global financial crisis. From June to November 2008, the government funded 94% of its $1.1 trillion of debt increase through T-bills. However, back then, these shorter-term instruments matured, and rather than rolling them, the government issued bonds and notes to extend the maturity of its debt outstanding. This transition is precisely what is happening today. Note, however, the average maturity of total marketable debt outstanding is already near record levels today. We think the index shown in some charts today through the news, so make sure you do check out those charts through ainslebullion.com.au for today's news. It's likely to move higher from here. In the last 3 months, we've seen over $560 billion of short-term government instruments mature. This is the largest decline in outstanding T-bills ever recorded in history. With the largest imbalances yet in both overall debt to GDP and financial asset valuations, the levitation of the entire equity and fixed income markets and the stability of the economy have become dependent on maintaining ever lower interest rates in the US Treasury market. 10-year yields started to yield around 0.9% and are now near 1.6%. That interest rate increase happened over a time period when the Fed was buying close to 35% of the net new issuance of Ts. We expect even more upward pressure on rates because of the Fed's planned tapering. The Fed has always been trapped, but this time it's as trapped as it could possibly be. We worry that the Treasury market is about to face one of its largest supply and demand mismatches in history. As a result, we think this imbalance could cause 10-year yields to rise as high as 2.5 or 3%, or even more. If this move materializes, the yield curve control narrative will become as prevalent as ever. It is the first time in many decades that developed economies are having to choose between reducing monetary stimulus due to rising inflation versus adding further liquidity to cope with decelerating growth. Inflationary conditions are forcing policymakers to pursue an impossible mission. Tighten financial conditions just enough so risky assets stay afloat without inflation getting out of control. We all know how it ends. Inevitably, a financial shock is triggered and central banks must resort back to liquidity measurements. Also, separately, do commodity markets even care if 10-year yields are at 2.5 or 3%? It's probably meaningless. The inflation genie is already out of the bottle, and a mere increase in interest rates would still put today's financial conditions among the most repressive in history. Then what happens with gold if long-term yields are poised to rise? Let's use the 1970s, as an example. Nominal yields trended higher, and gold followed along the line almost perfectly. By looking at the euro-dollar curve, the market already expects the Fed to be raising rates to 1.25% in the next 2 years. If policymakers would pursue that as a plan, the Treasury curve would almost certainly invert today, triggering a recession signal. It is necessary for the Fed to allow long-term yields to rise to even consider hiking short-term rates. Today's interest rate policy is perhaps the most aggressive interest policy we have ever seen. Considering where the GDP growth, inflation, and unemployment rate is today, the Taylor Rule baseline model suggests that the Fed fund rates should be at 9.3%. Keep in mind, this calculation presumes CPI is an accurate measurement of inflation, which we obviously do not believe this holds water. We think year-on-year growth in inflation is at least low double digits. That's right, not 9%, probably more around 11 or 12%. And if correct, we are indeed living in the most financially repressive environment in history. Aside from what's happening on the monetary policy side, massive fiscal spending continues to pressure the government to dig an even deeper debt hole. As we've previously mentioned, the fiscal agenda has 4 well-defined and long-lasting fronts: the Green Revolution, an infrastructure revamp, peak inequality, our fiscal arms race with China, in our opinion. These political efforts significantly feed into the inflation thesis. Additionally, while on one side, government spending clearly has no end in sight, on the other side, the US trade balance is deteriorating. Just in the last 12 months, the US had net imports of over $817 billion. The twin deficit, the current account plus the fiscal account, is now close to 15% of nominal GDP, almost 3 percentage points lower than the worst levels of the global financial crisis. We now have an explosive mix of fiscal and monetary excess, coupled with long years of declining capital spending in primary resource industries that could unleash a combination of high inflation and negative real economic growth at levels that we have only experienced in the 1970s. Economic deceleration is likely coming from Asia and spreading to the rest of the world. We are now seeing a significant number of negative surprises in the macro data relative to estimates. As a result, the Global City Economic Surprise Index is now plunging, suggesting that global PMIs should follow to the downside. So now we ask, if economic growth continues to decelerate while inflation remains historically elevated and high, what will the Fed do? A set of monetary and fiscal policies needed to fix one problem could worsen the other, and none of us own enough hard assets at all. Always good to hold gold in times like these. Jump over to ainsleyBullion.com.au for all things physical gold, silver, and platinum. Jump over to ainsleywealth.com.au. Jump on some crypto. If you haven't checked out crypto yet, do take a peek. It is worthwhile checking out the future of currency, or future of money, that being. And also goldsilverstandard.com. That's our own cryptocurrency built by Ainsley and backed by real gold and real silver. That's right, there's a gold token and a silver token. Good stuff. Thanks for joining us this week, everyone. We'll catch you next week for more news.